Hi, this is Randy Finney with Right Side of the Chart, and this is a mid-session update for Tuesday, September 19th, 2023. It is 12:25 p.m. Eastern Time as I'm starting the video, and here's what we're going to do. A quick update on the equity markets and some of the related sectors or things that stand out. The semiconductors, I'll take a quick look at the VIX, see what that's telling us or indicating, and then do some quick updates on some of the other commodities and other things out there like gold, silver, the miners, natural gas, crude oil, and time permitting, I'll hit on wheat and anything else that I've covered recently. Not everything, but some of the big stuff. Okay, most important development, although not as important as it normally would be, if that makes any sense. Forever and a day, I've been waiting for the next sell signal on the equity markets with a breakdown below this primary uptrend line. I'm referring to the red uptrend line. That's the 2023 all year, bottom, late December, early January right here. Beautiful uptrend line, and we took it out today. Now, normally this would be, and I've been saying for months now, if not at least so many weeks, that would be the next objective short entry sell signal. Problem is, I didn't know when it would occur, and it happens to be the day before the FOMC announcement. The Fed meets today and tomorrow, and at 2 p.m. tomorrow they announce the rate decision. And the futures tell us they're not going to do anything. They're going to sit tight, most likely. It'll be unchanged, but it's what they say. And again, it's not even so much as what they say, but how the market reacts to it. I'll tell you. So this is comparable. I always talk about this. If I have a setup and let's say a stock, let's say it's Apple, we'll pick Apple, and I have a bullish chart pattern and that stock breaks out, Apple breaks out the day before they report earnings, I take that breakout with a massive grain of salt. In fact, I don't put any weighting into it because I've seen that happen before, and we even saw it this last earnings time. A lot of companies had these false buyer sell signals right before earnings because earnings have the potential to override any technical developments, and not only that, but right leading into earnings, and I'm using, in this case, it's the Fed announcement. We only have the big rate decisions, come every so often throughout the year, and for over a decade now, up until the last year or so, it didn't matter. We were in a super low, near zero rate environment, and there's always people watching and listen what the Fed says, but the market's been hanging on Fed's every word, and because that's everything right now. We are in the first true inflationary environment in nearly half a century, and so interest rates are everything. More so at any point in time, again, for almost a half a century, what the Fed does makes a huge impact on the market. So therefore, I use that analogy. It's kind of like, taking a breakdown that happens the day before the FOMC announcement. We're just under 24 hours from now, just over. Again, this means nothing. I wouldn't act on this. I wouldn't change anything. It could prove to be a whipsaw. It could prove to be the real deal. We just won't know until after the dust settles. That means not at 2 p.m. You get the 2:30 press conference with Powell. Then the market takes a day or so to digest. I still can't rule out that marginal new high scenario. So to me, really, it's almost coin toss odds. I'm going to go over the technicals, show what they're saying, and more importantly, what to look for, because the markets move fast after an FOMC announcement. And if you're new to the site, I've been saying this for many, many years. It's just like earnings on a big earnings report for a stock. Never ever read too much into the initial reaction. I'm talking if you're watching a 1-minute chart, what you're going to see tomorrow, 2 p.m., you're going to see this. You're going to see the 1 minute, these are candlesticks, right? It's either going to shoot up or shoot down, and the initial reaction. I've yet to ever see that initial reaction not get reversed. That means if the initial reaction is a sharp spike up, I've never seen it just continue up or continue down. There's almost always a fade, and then that fade is sometimes faded. My point is, it's all noise to me. So don't overreact on that, because I've seen futures spike up or tank at 2 p.m. after the announcement, and then Powell comes on 2:30 and he starts talking and he says something that the market takes the other way. remember, it's the algos. The computers are typically the ones doing all the buying and selling, the parsing through the data faster than a human can read and act. And that's what's going on. And your stops are getting hit, and it's just noise. I call it post-FOMC noise. So, kind of let the dust settle. Maybe we'll get some clear direction. I mean, the charts there's a lot in there right now. So if the reaction is down tomorrow, if we close today down, and especially the redder the better, a solid close below there, again, you have to take it with a grain of salt. It doesn't mean the breakdown can't stick. It just means that there's a decent chance that it could be a whipsaw tomorrow if we do this after the FOMC announcement. I think the market's going to like what it hears, but again, it's not always that. The market it's the way it works. It's kind of tricky. You got to, at some point, how much of this has been priced into the fact that the Fed was going to eventually stop or pause the rate hikes. And so the $1 million question is, where we go from here. So that's why I'm giving you levels to watch. So I can tell you that post FOMC or any point from today, the farther we get away below this trend line, I have minor support here at 365. And then, of course, this is it's the first target. I gave you these QQQ targets the other day. Sharpened my pencil on it. T1, 354.70. That's that August 18th low. That's my next and final kind of all-in moment. And if we take that out, I believe that will significantly increase the odds that we're going to go and hit these additional downside, what I call near-term swing targets. If that, to use that definition. What I mean by that, I think if we get down to T5, I think there's a good chance. Anywhere T4 or T5, it's pretty good support. That'll probably be an area, again, depending on how the charts look at the time, to maybe game a counter trend bounce. Maybe not. We'll see. There's a lot in the charts that say we can, I think we're ultimately going down lower within the next year or so, sometime possibly in 2023, but most likely in 2024. We're going to go down there. We're going to take out the previous bear market lows from October 15th. Okay, but first things first, guys. I cannot rule this scenario out at all, and this is still my primary and preferred scenario. You have a downtrend line here, so if we have a little kickback rally, look for that. A break above that should be near-term bullish. So here's the levels to watch. I'm giving them to you right now on QQQ. The downtrend line, that's your first resistance overhead. Then you have this spike, previous reaction high from September 1st. I'll put a line there for you right now. And those are the two resistance levels overhead that, if and when taken out, increase the odds of that marginal new and still divergent high scenario. So nothing's changed. I'm not waffling. My intermediate to longer term outlook remains bearish. At some point, if the charts convince me, and the fundamentals to an extent, but mainly the charts, I may change that outlook. As of now, I think at best case scenario, it's a marginal new high. Marginal meaning, within, there's no hard number, anywhere, let's say roughly 5%, give or take a few percentage points, would be that marginal new high scenario over the previous high of July 19th. Okay, so that's still an alternative scenario, and it's still one that if you're taking, if you subscribe to it, if you are on the same page as I am, then, and you're a less active trader, more of a swing or trend trader, and you're short from back here, we've had sell signals along the way. This is just the next one to come. But you could ride that out if this was, let's just say you shorted, we had a breakdown way back here somewhere. Oh, yeah, was that right there on that trend line break? You could ride that out because you're only going underwater on that initial position by about, 3, 4, 5%, and have stops somewhat above. So let me show you now if that doesn't happen, what to look for. Of course, I just gave you the levels, 365, 350, 470. If and as each one is broken, especially a daily close, you're going to get that post-FOMC volatility, and it's easy to spike through down below a support level or above a resistance level briefly in intraday, only to see it reverse. So just keep that in mind. The odds when you get a solid daily close above support, especially when you're trading off a daily chart, which we're looking at here, that's where you want it. That's where the signal is confirmed or validated, not intraday breaks, but daily breaks and closes above or below support or resistance. Okay, so those are the levels to watch. Developments to note right here. We have a bearish PPO crossover. If you put up the histogram, you can see that better. There it is right there. So what I look for are what I call these hills, these green and red hills. These are trends. The PPO is a momentum indicator, and you can use it as a trend indicator. When the trend is bullish, you see a green hill, right? We got the PPO flipped, gave you a bullish crossover. That's when these lines cross. The PPO line crosses your signal line. It says, hey, long, the rally, it's in rally mode. When you cross down below, like right here, you have a bearish trend. It wasn't much because the primary trend was up, so these bearish trends were smaller, but they were the corrective waves within there. And so they've gotten a little bit bigger since. So we have a big inverted red hill right here, right? All this way here. And it was, for the most part, we were in a downtrend. We had a little counter trend rally, but look, we just crossed over recently. And you can see they're fairly predictable. Red hill, green hill, red hill, green hill, red hill, green hill, red hill, green hill, red hill, green hill. And so if it's going to be a red hill, that says more downside. So everything I just showed you there points to more downside. The breakdown there, the PPO crossover. If we didn't have the Fed tomorrow, this would be a pretty aggressive add-on or entry for me. That's the easiest way for me to describe it. But we have to temper that down because the odds of a whipsaw are elevated because of the FOMC meeting. Again, doesn't negate the breakdown. It just puts that little kind of question mark in there. Okay, I think that's enough on that. Weekly chart. Remember, we had, as I pointed out back here weeks ago, a weekly, the same thing that holds true on the weekly chart. You have these big trends. This is a bull trend. That was when the market bottomed in October with PPO flipped right after the bottom. There was the bottom, and we flipped to green, and we stayed green. Look at that. There was a correction, but with the histogram stayed green. So you wanted to be long and strong throughout it based on that one indicator. I mean, there's other things out there. And we crossed bearish here. So if we're in a bear market, we're going a lot lower like I think we are, then we could be looking at a much bigger red hill like this one right here that happened early on in that bear market. And that would be, these bars would get bigger and bigger and go on longer and longer. So that's that. You see a similar thing on the S&P 500, recent bearish PPO crossover on the weekly chart right here. When I go to the daily chart, we took out today, this is a busy board, but I'm going to highlight the most key level, this uptrend line right here. I might have it on a clean board. That comes off the March lows, and you have several reactions here, and you just broke below it there. Another indicator, another way I use the PPO on the daily, I have a line right here. Typically, I'll use the zero line, that's the dotted line, but I look at every security, every index differently, and then I put my own level. So on SPY, I have a level here, a horizontal line at negative 0.64. And what I look at is the 9 EMA, the signal line, which is the slower of the two. It's the last of the two to cross. And typically when it's that level axis support and a bull trend, when you're above it, the trend is bullish. So we crossed above it here, and we've remained above it this whole time. So it said get long here, again, by that one indicator. And that's still on a buy signal. So what we're going to watch for is a cross down below 0.64. This was in sell mode here, or bear mode. And you can see, just box it in, go ahead and look above, and you can see those were the times the market was in a downtrend, and when it was above, you had your bear market rallies, and we were long and strong those bear market rallies for other reasons as well. So that's just something else to watch, and I think I already have it, but I'm going to set an alert there. That'll tell me that. Sometimes I forget to check each and every board. I have a lot of different boards. There's a clean board on SPY, divergent high and bearish engulfing candle, which is still in play. We never went above that. That so far has marked the top, just like you had a bullish engulfing candle back here that marked the bottom. And so this is still my preferred scenario. And there's the big levels. You see them in red. This is the magic number for S&P. 433 horizontal price support plus the primary uptrend line off the October lows. If and when that breaks, that's a powerful sell signal. My minimum swing target's going to be down there at about 416.30. Again, I cannot rule out a marginal new high, but as of now, that's my best case scenario. It doesn't, anything much more than that, meaning we go up a lot more and take out the divergences, I'm just wrong. But as of now, I'm going off this as being a potential top, and we're in a downtrend with more downside to come. Okay, that's that. Let's look at the VIX volatility index. Let me go to this main board here. So what you're looking at here is on the weekly, the bigger picture. Let me just toggle over to the weekly chart and let me park this PPO histogram, get that out of the way. We're done with that. Squish this down, focus on price. This is kind of big picture from the weekly. You have a downtrend line right here on the VIX and an uptrend line right here. We took out that uptrend line right there and we're below that triangle. So if we can pop back above it into the triangle, that'll be a false breakdown, and then we'll probably pop above the downtrend line and shoot up. These are kind of weekly swing targets for the VIX here, and that's where we got back when COVID hit, all the way up there. But looking at the daily chart, which is a little bit kind of honing down short term what may happen, this to me, we certainly have a technical posture that says the VIX is ready to rock, because we put in a divergent low here. And we had a nice rally, by the way. The VIX, the VIX is going to go up big in percentage points, in percentage terms. That was a 51% rally off this divergent low. So it's not as if these divergences don't work. They don't always work, but they typically play out for trend reversals. I like to look for them. And so what we did here is we made a marginal new low. A lot like my marginal new high scenario in the stock market. That's what the VIX did. It made a marginal new low there, ever so slightly below the previous one, was still a divergent low. And that's where that pop came from there. And again, a marginal new low. And you can see the PPO is curling up right now. I think you can see it. If you can't, you can tell that by the histogram. The histogram bars are coming, and when the PPO lines cross, that's when you go from red to green here, when you cross the zero line. So that looks ready to pop. Now, the Fed meeting can foil it. The VIX could go down. I wish we had better support here on the daily and weekly. We don't, but you don't always have to be at support to rally. I just wanted to point out that we do have the divergences and the potential to rally on up there. And here's a downtrend line right here on the daily you can look at and target. But we should know more. We certainly should know more by the end of this week. Again, don't react unless something huge happens tomorrow. Big move. And I need to say this too. Big moves in the market, to me, can either mean absolutely nothing, a 3% plus day, or it can mean a lot, depending, is it random? If you look at the market or an index, we'll look at QQQ, a 3% up or down move, if it's 3% down, that's going to put us, and we close there, that's going to help confirm this breakdown, and that would be technically significant. We pop back above there. If it's up here and we break out above 381.14, that's also technically significant. Anything else in the middle that puts us right back here just keeps us above trend. In other words, these are random. Some of these are big moves, but they didn't mean anything. They just random up, random down. To me, this is significant when you have a breakout above a trading range like that. Those are technically significant moves. Okay. So we'll see if what happens in the next day or so here. All right, moving on. Okay, enough on the equity market. So, it's all there in the charts. If we can head down post Fed, this breakdown will be confirmed. Then look for the breakdowns in SPY. Look for a break below 354.70 in QQQ. That'll increase the odds that we're going down to these deeper targets here. Likewise, if we reverse and pop to the upside, that increases the odds we're going to go make that marginal new high. And I showed you the VIX. The other one I showed you last week, we had a sell signal on the stocks. Or was that last week? Yes, that was Friday. Yes, it was. So here's my clean board right here. That shows you the primary uptrend line off the October lows. There's your breakdown candle on Friday. And so far, follow through to the downside. That is what you want to see on a breakdown. Again, no guarantees that it won't be a whipsaw. But the farther you get away from the breakdown, the more follow through candles, more downside that you have, the greater the odds it's going to stick. So I have semis on breakdown mode, sell signal, and SXD is another semiconductor ETF. There's 3 of them I track: SOXX, XSD. They're just different companies. This is Spider's S&P Semiconductor ETF. Just hold a different basket and different weightings in the semis. And there's a breakdown all day long. Broke down also on Friday with 2 red follow-through sticks, which is what you want to see. And again, it's not random either. It came after a divergent high. This was our first sell signal in the semis back here. Let's not forget. So it's been a short trade idea since then. There is some divergence forming. So if the market, I'll tell you, if the market is going to giddy up and rally, and if it's going to make that marginal new high, I think this is the week it has to do it. We've broken support on the semis. We're not too far below that they can't recover. QQQ just broke today. Much more downside is going to just firm up those breakdowns. Whereas if we can turn around and rally, you have the potential, you have positive divergence forming here on the semis right there. And the other one is SOXX, I already covered. XSD, and oh yeah, SMH is the other one there. So just so you can see them all. SMH is VanEck, Vectors Semiconductor Sector ETF. Uptrend line, nice clean. These are clean uptrend lines. So these are solid breakdowns, so far. Nice support right there. There's kind of like a line in the sand number, 143.19 on this one. Nope, I wanted to set an alert. And so these are the levels that, if taken out, increase the odds that we're going down even more in the semis. So again, this is it. We've got the semis are gonna, if this is gonna be a false breakdown, it really should happen now. And then that would give us the same thing, a marginal new high scenario, extend these divergences, and I'll be singing the same song I'm singing right now. Divergent high, most likely a bear market rally. I don't care if it takes out the previous highs. I don't get tied up in the semantics. Is it a bear market, a bull market? I'm looking at directions where we're going. Some stocks in the Nasdaq and S&P have made new highs. Most haven't. Most are well below their 2021 or early 2022 previous bull market highs. So to me, we're still in a bear market. We're probably have seen the end of a nice big bear market rally with a lot more downside coming. And again, even if it's delayed a little bit here with that marginal new high scenario, which is still my alternative scenario, I still can't rule it out, and hopefully I can start to rule it out this week. So that's it. You know where the semis stand, what to watch there. They're active trade. If you short the semis right now, there's no reason not to. I would just hold off to the Feds out of the way and get those confirming sell signals on QQQ before adding to that position. Let's talk about the other stuff. Gold, silver, I made it clear that silver is usually my preferred trading proxy when I'm bullish on gold and the metals. Divergent low, rally, divergent high, correction. Simple wash, rinse, repeat stuff. Divergent low, rally, divergent high, correction, divergent low. We went long here, right at support the other day. At this point, I would raise that stop because we caught that low. Remember, we said go long here, but give it a little room in case they want to do a little false, breakdown, undercut the lows. But we've already started a rally. Now, look, we could still do that and go there. You can leave that stop if you have a good entry. There's nothing wrong with that. But if you want to protect gains, or at least a break even, you can raise your stops to entry right now, or a little bit. That's still support. I'll be honest, I would keep it a little bit under there at this point if you're swinging for much higher levels. Remember, we're coming off that divergent low, so there's potential for a lot more. Gold, I'm on, by the way, guys, I know I'm talking fast and running through these charts fast. I just want to cover a lot in this video. Same thing, divergent low, divergent low. There's a downtrend line. So gold, if it can pop this downtrend line on the 60-minute chart, it should continue to run up. It's coming off that divergent low right here, positive divergence. And then palladium I gave you as a trade idea the other day too. That one still looks good. We're coming off that divergent low. We had a breakout above the downtrend line or wedge pattern here. Big divergence on palladium. And these are still my targets here. So just don't let it get away from you. There's no reason to. It's overall, it's been in a downtrend since this blow off top. And, maybe it is going a lot lower when I look at the weekly chart. It's certainly possible. But it's a pretty good support. Not, whatever. It's a way to diversify. Don't put all your eggs in one basket. Have some at any point in time, whether it's long or short, precious metals, commodities, agricultural commodities, energy commodities, bonds, crypto. Those are different asset classes. And the more you spread your eggs around those different things, it's going to soften the blows. If you're trading only QQQ or only the semis or only crypto, you're either going to be very happy one day or very, very unhappy. And that's what diversification is all about. Your crypto's down one day and your palladium is rocking, or your wheat or corn or soybeans or whatever. So that brings me to wheat. No change in wheat. Still big positive divergences on the daily chart here. And these are the longer term swing targets. Remember, we already hit T1, T2. These are longer term targets. And on the 60-minute chart, I gave you some targets recently. Mentioned it off this divergent low. There's an objective long. I still like it. It's moving up. Should have T1, T2, T3, T4. And again, on the daily chart, I have longer term targets, and we'll probably work our way up there. And this is a big level. If this trade starts to get some traction, this is a big level up here at about call it almost 750 right now, 745, 750. It's just capped all the advances so far in wheat. And if wheat can pop above that, and again, it's got a ways to go to get there, but that would be pretty powerful stuff. And again, you can see it here on the daily chart. It's this level right here. Big, 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 big resistance. So watch that. Longer term, that would be bullish if we can break that out. And then, things, corn follows wheat. Same technical posture. The divergences I pointed out here are still very much intact. It's holding the support around 21 bucks right there on corn, COR, and the corn ETN. Positive divergence is still in place. You could probably add a little downtrend line, minor one right here. And so if it can pop up here and take out 2271, that should open the door for a bigger move up, I think. Oh, let me just, while I'm doing the video, if you're active trading, I've said this many times, the realm of the active trader, this is what I'm doing most of the time when I'm not doing these videos. I'm just swinging the NQ futures long and short. 5-minute chart is one of my go-to. 15-minute chart, 10-minute charts, but the 5 minutes hard to go wrong with. And you look for these divergent highs. Obviously, you want to see if you can trendline breaks or falls to support or breaks above resistance to go long short. But divergent high, drop, divergent low, rally, divergent high, drop, divergent low, rally, divergent high, drop. Almost a divergent low. Indicators were close, and then rally. Divergent high, little falling wedge there with the negative divergence, and drop, divergent low, divergent high right here, and this led to this drop, and now we have pretty big divergence. So this would say, and so I'm long. I reversed earlier today, a couple hours ago, from short to long based on this, because also from my experience today we were down about 1% when I did it, and we were up a little bit now off that, but I think we're right about the 1% mark. And from my experience going into an FOMC meeting, there's a lot of mean reversions. The market's not going to make any big moves. It tends to go in a holding pattern. So when you get a 1% drop intraday and you have positive divergence, they're probably going to buy that up into the close. And you can see this would be a near-term target right here. And this is QQQ, not the futures, but the futures tell me the same thing. So, good for about it's about a 0.75% pop up there. And, or just let it run, put a stop in place, and just let it ride. And they'll probably, this 5-minute divergence based on the scope of it could certainly play out for much more, maybe a rally up here to about 372.25, and that would be good for about a 1.5% pop. But a big but, stops are a must, because remember, we just broke support on the daily. So I learned long time ago, don't get lost in the world of the intraday charts if you're an active trader. It is the realm of the active trader, the day trader. But if you get completely wrapped up in this and you're not paying attention to this is important, especially if the Fed wasn't on there today. I would not have reversed on a 5-minute divergent low, because this is supersedes anything on the 5-minute charts. That's a breakdown on the daily. Again, I think it's going to be probably bought up, most likely, because of the holding pattern the markets tend to go into right in front of a big Fed meeting, but we'll see. Bottom line is, takeaway, that the technicals continue to deteriorate and help, in my opinion, firm up the bearish case, but there's still a little bit of work to be done. Let's see what I have not covered here. Oh, let me just quickly go over my things to watch list, my TTW. In no particular order, let me sort the list by gainers and losers. All right, so Carvana, I mentioned that to you as a trade idea the other day. Said we put in a divergent high here at resistance. That's a big level right there. It's about 57.90. You had a major reaction high there, one there. We hit it again, and we did so with negative divergence. We had prices making higher and then equal highs. There's your divergence line, started there. Put in an equal high with the indicators severely lagging. That is negative divergence. And so there's your targets right there for Carvana. That's down 10% today. I was mentioned the other day right here, I think, right around that 57.90 level. So you're up about, give it roughly 10%, 12, 15, no, I don't know. Let me measure it there. I don't know exactly where. I think it was last week I highlighted it, and it's up about, 20%. Copper. This is a big one. They used to call it years ago, for those of you old enough to remember, Dr. Copper, because it had a PhD in predicting where the economy was going. Why? Because every time there's economic growth, houses and industrial complexes are being built, cars, there's a lot of copper used in the wiring and everything else, and so therefore then kind of got distorted with China coming online and drawing so much of it. So years back, someone was jokingly stripped of its PhD to predict, but I think it's still worth watching, especially lately. And you can see either way, solid breakdown. This is the copper index here, but either way, divergent high right there, and nice breakdown as well. So this is another reason, again, it's post-Fed or pre-Feds, take it with a grain of salt, but watch it. More downside, that's an indicator. It's in my things to watch list. I'm just rifling through these. TIPT, this one was a trade idea back here. We shorted it there, hit our first and second targets, bounced, and we've come full circle. We have a beautiful uptrend line, which we're really close to, so I'm sharing this as a trade idea. And divergent high, break of that would take us down. Just use the same targets as before, T1, T2, and T3, which I still maintain, think it'll be hit. And so that would be, if we get a breakdown soon, that's the potential to make about 40% on a short trade. CarMart, right at trendline support there. KMX, CarMax, I covered these quite a bit. Divergent high, breakdown, it's kind of in this trading range. And MCO, Moody's, big bond insurer, and that's one to watch. I think there's problems. I think there's problems everywhere, potential problems in the financial system. You know me, it's just what I see, but everywhere from municipal bonds to corporate bonds to pension funds and things like that. It's all intertwined, and I think it'll all play out. And this is one to watch, because if there is problems in muni land, you're going to see these bond insurers start to price it in. So this one broke down. Technically, it's a breakdown, perfect back test, and still offer an objective short entry to swing to any of these targets, and that's MCO. Auto and truck dealerships, I covered those, Carvana, CarMax, and CarMart, they're all in there. MA, MasterCard, big financial, big triple top, 1, 2, 3 right there. Well, I believe it'll be a false breakout. It's not a short yet, at least not an objective short, but it will be when it breaks this trend line, this big old bearish rising wedge, and that should bring us way down. Plus, if it does break down, it's going to be a failure. It means this whole triple top breakout will be a failed or false breakout. So that's one to watch. And of course, it's one to watch. It's in my things to watch list, because that's MasterCard. MasterCard and Visa are your biggest credit card companies. When things are booming and people are swiping, they're doing well. They get a percentage of every swipe. And it goes the other way when things slow down. So that's why I'm watching MasterCard and Visa closely. ADP, another one I'm watching. Biggest payroll processor. Divergent high, covered it here, overbought conditions, simple stuff, and then it's overbought with the divergence of what you really want to look for. And when you get that, you get this. These are your overbought conditions. Boom, boom, boom. So this one looks to be headed lower. And as I've done in the past, and I won't do now for the to keep the video short, overlay the S&P 500. Go back as long as you want. You're going to see a near perfect correlation. So because when the economy is good, ADP is good. There's a lot there. Business is up, a lot of payroll processing, and when things turn. So this is, and it can be kind of a canary in the coal mine for the employment sector, which is the one big thing. That is the one thing the bulls can really hold on to support a bullish case for stocks up through the remainder of 2023 and into 2024 is the job market holding up. But as I've showed you, yes, we're at record low unemployment, but it has been employment. But unemployment has been ticking up, jobless claims, that trend has reversed. And as I've showed you in the past as well, and don't have time to do in this video, that every recession, every bear market starts at record low unemployment. So it's almost a contrary indicator, if you will. When you get down to the levels that we've hit recently, those are the levels, and you don't stay there long, and I showed you that before. And if you don't know what I'm talking about, if you're new to the site, go to, there's some websites, macrotrends.com or .net is one, or you just Google search unemployment data chart, and then overlay. Most of those charts will let you overlay the S&P 500, and you'll see what I mean, and they'll shade in the recessions and show you that. So this is one I'm watching, because if and when the job market finally rolls over, that's it. Consumer spending accounts for over two-thirds of GDP. So the government can spend away and stimulate all they want, but when the consumer rolls over, that's it. The economy rolls over. So watch employment closely, and that's ADP is a big one. JP Morgan, I've shared my thoughts there recently, broke down recently below the primary trend line, big old wedge pattern, and just by simple technical analysis, let's not overthink this, tells me it's headed a lot lower. It needs to break that 143.85 it just bounced off of. That's the next big support. Then it'll go on to hit my 4 targets down there. And it's already in breakdown mode. It's already objective short. It was here in the breakdown, still is below that trend line there. And again, also, Bellwether, the biggest bank that we have. And so the fact that they're on a sell signal doesn't bode well for the financial sector. Copper is another version of it in a triangle. Visa, I showed you MasterCard, same thing. Look at that beautiful uptrend line. This is just that's a beautiful bearish rising wedge pattern complete with negative divergence. And anything's possible. Sometimes you get these beautiful looking patterns, they just don't pan out. But if it does, there's your measured target, widest part of the wedge. And if Visa drops there, again, you can just overlay it with the S&P 500 and you'll see high correlation too between the credit card companies and the S&P. FedEx, another bellwether, kind of a gauge of where the economy is going. Obviously, if the economy is doing good, FedEx and UPS are doing well. FedEx broke down and it's been moving lower, so it's also an active short sell signal. There's your targets. Let me put that one up. 199 first target, about 232, and then 199. That didn't work. Color it up, make the line a little thicker. There it is. Okay, so that's where FedEx looks to be going. Semi's already covered. Caterpillar broke down recently after a divergent high. Paychex, another big payroll company, breakdown there. Sell signal, it's moving lower. So that's it. The majority of my things to watch. KRE, that's where I said time to start shorting the bank stocks. Or regionals again, went down, had a leg down. Little bear flagging action right here, broke down, it's moving lower. So that doesn't bode well for the economy either. The regional banks moving lower again. Specialty finance, I have a bunch in there. I'm watching like Rocket Mortgage and others. PCZ, told you I see problems in California is an area I've been watching. They just, one thing after another I've mentioned, they're massive, biggest public pension fund in at least the country, if not the world. California is the 7th largest economy in the world. It's bigger than most nations, their economy. And so, CalPERS has been grossly underfunded for years. There's no way in God's green earth that their numbers have been good. I mean, they report them, but then even when you look at the latest, when you look at the old 80-20 rule blowing up and with bonds sucking wind and top of stocks, and now private equity having some cracks showing, and they've shifted a lot of money into private equity. And my point being that taxpayers are on the hook for CalPERS shortfalls ultimately. Again, and say what you want, and I could sit here and ramble on fundamentally all day long, but we're coming up on the previous lows. This is when the stock market bottomed back here, remember, in mid-October. And so for some reason, California muni bonds are there, but when you look at national muni bonds, which I showed you the other day, they're still well off the lows. They're moving lower, which isn't a good sign in itself, but CalPERS is down here. So that tells you that California is underperforming the muni market as a whole, which is also falling. And that's not a good thing. It's not a good thing at all. So watch that. And California, again, and that's just one I use, guys. I know I've said this before. There's other ones out there, but they're all similar. And this one's indicative. It's PIMCO, California Municipal Income Fund. You can look at all the other ones. Just type in, if you have a TC 2000, just type in California and then Muni, and you'll see all the different ones. MUC, Muni, this is California. BlackRock Muni holds California Quality Fund. What that most likely means is they're all the higher rated ones. Quality would imply triple B or better, just like LQD, which is an investment grade corporate bond fund, is to that. Whereas you go under the triple B rating, you get it at junk bonds, and that's that. So I'm almost done here. Fallen already. I covered bonds for you. AMBC, another bond insurer there. We shorted that one way back here on the breakdown. T1 hit, T2 hit, and I highlighted on the bounce back to resistance. It continues to work its way lower. T3 and T4 down here. Also says something what's going on there in the municipal market, right? So that's why I'm watching. I'm always looking for where's the next shoe to drop. And those are, again, things that I'm watching here. PSP, private equity, I think there's a shoe to drop in there. Private equity sector. This is an ETF that holds the companies like Blackstone and KKR, and I don't know why Halliburton's in there. Blue Owl Capital, Carlyle Group, and et cetera, et cetera, et cetera. All right. And then the big one, TNX. Let's not forget the 10-year yield. It's poised to break out. It's testing its multi-year highs. These highs, this is the high from October when the stock market bottomed here in October of 2022. But this level, if you follow that line to the left, like I've done many times, takes you all the way back. The last time we were there before that was goes back to October of 2007, right when the bear market that preceded the financial crisis began. So rates are back to where they were then, and they're poised to break out. We've been pushing against this level. Obviously, a breakdown below here that would be bullish for Treasury bonds. Remember, this is rates. These are the 10-year yields. So if the yield goes up, the bonds fall in value. And if the yields fall, the bonds will rally. And we're pinched right here at the apex of this triangle. Could go either way. I've talked on this before. If yields break down, it can be one of two things, but one of those two things could be a powerful sell-off in the stock market, institutional flight to safety, buying treasuries, or it could be just a natural decline in yields. But I almost see it a lose-lose situation for the stock market, because if it's the former, meaning institutions are selling equities, flocking into treasuries for safety because the stock market's going down, well, obviously that's no good. The only other thing that should bring long-term rates down is future growth expectations going down, being tempered down, and that also doesn't bode well. So I don't know. We'll just watch it, and let's watch it, and then there's a lot of possibilities, but I can tell you we're very close to breaking out to new multi-year highs or breaking down that primary, very well-defined uptrend line there. So definitely one to watch. And I think we'll end it here. That's enough. So like I said, near term, if you want to ask, if you want to know what I think will happen between now and by the time you're finished watching this video, we'll probably rally back up. I gave you some levels based on this 5-minute chart, maybe until tomorrow, until the Fed meeting, and then I forgot the energy commodities, my bad. UNG still looks good. I highlighted it here recently off the divergent low. Still moving up off this most recent divergent low on the 60-minute chart. And then crude's been hanging in there. I mentioned it as a short last week, but I still think crude's ready to correct. It's also been should be putting a lot of pressure on the market, more than it has been, with these rising crude prices. But there's that wedge, that 60-minute wedge. So we had a little whipsaw there, but it's broken down again, and these are still my targets, and I still think we're going to have at least a pullback to T1 at minimum. The S1, you could make that T1 now. That means first support. If you want a shallower target, that would be a drop of 3% on crude. T1 would be 5%. T2 would be 8%. And then T3, if that's it, it's going to be about 10%. So we'll watch that. But I think I still like this as a short. So short crude, long off the divergent low, shorts off the divergent high. And that's it. And then so I'm bullish. I'm sorry, near-term bearish crude, despite the current uptrend. Bullish natural gas, long wheat, silver, gold, palladium, and like I said, bearish the stock market right now, but kind of tempering my bets until the Fed's out of the way. Hopefully that all makes sense. Let me wrap it up here, get the video out to you guys. This has been Randy Finney with Right Side of the Chart. Have a great day.